Hey guys, welcome back to the channel. I hope everyone is doing well. So unfortunately, the timing of this video might not be like the greatest since like the it's been a kind of a rough start to like the new year. But I think it's still helpful to kind of like go through maybe like some potential disaster planning, at least mentally, for the Defiance ETF, zero DTE funds. So what can we expect from market disasters? So I think it's helpful to kind of go back in the past and see how the VIX did, at least historically, with the records that are available. So the high point was 89.53 back in October 2008. For the VXN, for the NASDAQ, the high point was 91.79. So that was back in September 2001. The RVX, the high point was 88.79 back in March 2020. So I think we kind of know what happened, and then just to kind of refresh ourselves as to like how bad like the volatility was. It's kind of interesting to note, even though they occurred in different time frames, they kind of correlate somewhat. Uh, and it's interesting how they kind of like cluster around like the 90 level, even though it was in different time frames. So for the purpose of this exercise, I kind of wanted to look at like what were the biggest one-day drops. So I chose October 19th, 1987. That was Black Monday. Now this was before my time, but I kind of vaguely remember when I was a kid, like just like uncles like going crazy, like trying to figure out like what was happening. But I was a little kid at the time, so I guess like that didn't really affect me as much as like unfortunately these other three events. So yeah, like the unfortunate September 11th attacks. Then you had like the great financial crisis, and then like the I guess like the health incident 3 years ago. So this is something that my one of my boss used to like tell me all the time. Experience is what you get after you need it, because sometimes um, no matter how hard you plan and how hard you study, you know unfortunately in life things happen, and there's no really good way to kind of prepare for it. I think the only thing you can really do is like kind of mentally brace yourself for when, I guess, like when these bad things happen. um, and it's also helpful to see kind of like what would happen if JEPY, triple QY, and IWMY get hammered with a incident like this. So I had to make some assumptions. So I looked at most of the time, like it looks like for Defiance, they try to get about 25%, excuse me, 25 basis points uh, premium per trade. So what I did was I went back to just for the purpose of this exercise, I took like uh, December 2023 closing price, just to kind of get an estimate of like how much premium that they could get. Some days you could get more, some days you could get less, depending on the volatility. Just to get like a starting point. So I just estimated that was like $11.92 cents for the 470.80 strike. Um, and just like kind of get like roughly 221 contracts. Because I was assuming that the net assets under management was about 102 million. Um, and then let's get outstanding shares was 5.7 million. And then I also kind of assumed that on January, like the first trading day of the year, that poop happens. Unfortunately, poop did happen, but it wasn't like big poop. It was just kind of like just normal, like a normal down day. Thank goodness for that. But what if if the market had dropped similar to like the like Black Friday? Would have been like see Black Monday. Uh, it dropped like 22%. That would unfortunately bring like the SPX down to 3,720 um, and 47. And then the VIX again, what if it went all the way to 90? Um, and then I'm also assuming the JEPI shareholders don't bail out. But this is kind of unlikely in real life. But we have to kind of make an assumption because we don't know how many people would would just like you know just dump everything. Um, so then the loss would result in like almost 1,000 points, inclusive of any like premium collected. So that translates to around $23 million net drop in net assets, or about $4.06 per share loss. So if let's say like JEPY was trading around like 17, 16. So I mean, just having like like a 25% like drop off the top just in one day, and that's assuming people don't leave too. Um, so like if that were ever to happen, Defiance would have like a really uh they have a tough choice. Like, do they decide to liquidate, or would they resume trading? Like, if like assuming that depending on what the incident is, like even the stock market itself might not uh, trade for like a few days. So and then let's assume that the assets would be like around like 80 million. And then let's say like VIX like stays elevated like around the 90 point. So what I did was I went to like you can go to like almost any online option pricing calculator, and this just kind of like what I would plug in. So I assumed the underlying price was theorized at 3,720, and then the exercise price would be like 33,730, like do 10 points in the money. And then this is kind of like the what would we get for the put option? So 74 65. So let's assume they did 213 contracts at 37.30, like the 10 points on the money. And then we assume like it closed like kind of like slightly uh out of the money, so then we could get to keep the full amount. So we would get about like 1.6 million or 28 cents per share. So that would mean unfortunately we need like 15 winning trades in a high volatility environment just to recover. That would be really tough, but it would be plausible. But now, unfortunately, in times of like down days, I would expect like, you know, maybe like kind of like a brief rally, just because maybe like there's some bargain hunters. But in reality, it might be like a few net down days. So we have to kind of like assume that, you know, um, the Defiance might have a tough choice. Like they either the because of like the halting of trading, or like they decide like, well, it's not worth it because like too many people left, and they might have to liquidate. So what I did was I found like a few articles online to see like what would happen if like an ETF would liquidate. It will kind of be probably similar to like a bankruptcy. Like first, like we have to kind of they have to pay off uh, any off like losing trades like to the counterparty, and then anything that's left over that would be like sent back to like the shareholders. So I guess like you guys can read that in your own time. I provided like some links to like the both like past like uh disasters, financially speaking, and then also like hopefully you know cross our fingers we never get anything like this serious in our lifetime. But just to kind of give you guys like a perspective, it took about a year just to recover to like pre-Black Monday levels, and then it took 2 years to get back to new highs. So there's still like a some bit of hope, but we never know like exactly what could happen. Um, Depending on how, because even if you have hedges, just like from experience, it doesn't they don't pay off like exactly how you want them to. Like for example, if you had like any of the short ETFs or like the inverse ETFs, they they were helpful, but they didn't quite like uh, get to like the full either 1%, 2%, or 3% that they promise in the prospectus, just because like the spreads are so wide that even if you try to put in like a mid price fill, you might not get the fill. You might have to like you know like just kind of like sacrifice like a few pennies on a per trade. And unfortunately, that's gonna add up, especially in a fast moving environment. So always like get in the habit. Like if you're like really risk averse, um, always have like a cash allocation in good times, so that like in low volatility environments, like things are pretty liquid. Um, you can kind of get it in and out of positions like easier. And you can always like take your time to like DC into your favorite high yield ETFs. But you're gonna have to hold like a higher rate in terms of high volatility, because in high volatility things might not get as liquid just because like people are scared. They might not like want to um, uh, either buy or sell, and that makes it a lot harder to kind of like get good trades in. And then like I guess like what you can do, you can set like a have an amount that you want to reallocate when discounts arise. So the pros of this is that down markets could be painful at first, but high volatility. Don't forget that high volatility leads to like higher premiums, especially for puts. And there's still a chance that it could recover after some years. So I just kind of want to go back to like the premium example. So like in a typical day, like you might be able to get like $12 in like a high in a low volatility environment. But then like if ever hopefully things don't get that bad where the VIX goes all the way back to 90 again. At least I know it's not like it doesn't give you a lot of comfort, but at least like on the next day for the zero DTE ETFs at least, you can get like a much higher premium. So like 12 compared to 74, that's like more than 6 times. So it's just something to kind of like keep in the back of your mind as well. Um, and then just to kind of like go over the risk again. Um, Unfortunately, there's no way anyone can guarantee like a full recovery, because like when like these high volatility environments, the correlation for even if you're all diversified, because like in a market panic, people are selling everything, because maybe like some people are using margin, some people are uh, you know maybe have too much money like put into like risky things. So like let's say like you're into like some crazy crypto. Well, guess what happens? You know, people are trying to like raise cash to pay off like loans and stuff like that, or even just like to survive. So unfortunately, like sometimes like diversification in these high volatility environments, it may not be like even like a perfect hedge. So like that's why like the only thing you can do at that point is just like try to raise like cash whenever you can, and preferably like do it before like something bad happens, because you just never know when implied volatility, like it'll spike at the wrong time. And just to kind of reiterate, ETFs can get liquidated, but this is again in a disaster scenario. So I don't want to like kind of scare people, but I just want to kind of bring this out, just to be aware, and then kind of like read up on the information, kind of keep it in the back of your mind. I know like sometimes like when the market gets a little rocky, um, it you know people get scared, but I guess like the past few days they haven't been like that bad, but it's just like to kind of mentally brace yourself. So hopefully, like I'll bring like more positive content in the next set of videos. If you like this type of content, please consider liking. And of course, I always appreciate all my subscribers. So let's not like think like too negatively. Let's try to be like a little bit more positive. But sometimes it's good to kind of like think about like risk management as well. So I hope everybody makes some good money out there, especially this year. And thank you for watching, and I'll see you in the next one. Bye now.